Hello and welcome to Fund to Money. Here we will be discussing how loan against mutual funds or loan against mutual fund units or mutual fund loans work better than liquidating your mutual fund units. This typically happens when you are in need of funds and a common impulse is to use up your investments when you've run into an emergency, you need cash. People tend to liquidate their investment, and typically mutual fund units become a victim. Now, loan against mutual fund units or loan against mutual funds or mutual fund loans help you preserve your hard accumulated painstakingly accumulated mutual fund investments, and make sure that you progress towards your goals without any kind of long-term issue. So the idea is when you borrow or take a loan against mutual fund units, you basically manage to preserve those investments, and of course you can repay the loan within some months. It's basically a short-term loan and there's no long-term damage. You don't have to one is, of course, you don't have to take loans, expensive loans, which is credit card, personal loan, and the rate of interest for loan against mutual funds is far lesser. Number one, you manage to preserve the investments, and of course your progress is not affected at all, and the disruption is overall disruption, you manage to contain it, right? So here we're going to be discussing two things. One is, of course, why loan against mutual funds or mutual fund loans help you, why they score over liquidation or redeeming of units, and of course the other part is which we'll discuss are the major features of loan against mutual funds. Now, the important thing here which we need to remember here is this is basically for cash flow issues. You're falling short of cash and you think you will be able to make up in the future, you'll be able to repay the loan. That's when you should be taking it's not a solution for a long-term income problem, it's a solution for a cash flow problem, right? A short-term, some months, 5, 6, 7, 8, maybe a year. You can do that. This, of course, can be also a tool for cash flows for self-employed. That's a separate matter altogether. But like an FD can play that role. But for emergencies, this is the way to look at it. Now, the important part is, for emergency, the best thing for you to have is an emergency fund. Now, we have had some very long discussions here, whether it's how to prepare create an emergency fund, how to plan it. You can check out the links that they have been given, and of course, what are the investments that you can choose for an emergency fund. So we are not going to look at that particular area. That's been covered. Now we will immediately discuss why, what are the 4 reasons why taking a mutual fund loan or loan against mutual fund is advantageous compared to liquidating. And then in the second part of this presentation, we will discuss the major features of a loan against mutual funds or mutual fund loans. So number one, when you are actually in need of cash and you suddenly redeem or liquidate your units, which is a typical reaction for many investors, what is happening is the markets may or may not be in a good place, and you might be selling out because it's a fire sale, a distress sale. You might be selling investments at a loss or less than a level of gain which you will be satisfied. So in any case, you're not realizing the kind of gains that you should be realizing. Remember, any gains that you make also are taxable. So that is another aspect that you need to keep in mind. Taxes are a constant. So over a longer period of time, had you remained invested, that tax bite would not happen that much, but this is happening in any case here. Second is, of course, you would have invested for a certain financial goal, or certain financial goals, the progress is getting disrupted. So if you had taken a couple of years to reach the position that you are now, you are basically undoing that progress. So now what you'll have to do is, that's the third part, you'll have to now make up for lost time. You will have to invest more, save more, invest more, possibly take more risk, or maybe defer the goal because you don't have that kind of time. If you take more risk, then the chances of losing out are that much higher. So those problems are coming into the radar. And then of course, then you might be having very good investments with lots of future potential, and because you're exiting them early, so what's happening is that potential upside, that promise, you're having to let go, and that too much before time. So all in all, these four things are not they don't make for a very pleasant narrative. So maybe the idea is to avoid them if you can, and of course not also take expensive personal loan or credit card, use the credit card and have an outstanding out there, because those are they have exorbitant interest rates. So some of them. What you could do is take a road which is more manageable, which is loan against mutual fund units, and you can do that, and that will help you avoid this particular path. So in the next section, we'll be discussing the major features of loan against mutual funds. So we'll be back very shortly. Welcome back. Welcome to Fund to Money. We are discussing loan against mutual funds, or no loan against mutual fund units or mutual fund loans. So basically, you're pledging mutual fund units, and against those mutual fund units, you take a loan. This is pretty much like any other loan against asset, and because you're pledging an asset, therefore the rate of interest is lower than say an unsecured loan, which is like a personal loan or a credit card outstanding. So ideally, for an emergency for which you would people typically liquidate, a lot of people liquidate before time mutual fund units, you should be having an emergency fund. There should be a separate provision and planning for emergency. So we have had these discussions, we have provided the links. Now what you need to do is, if that becomes short and there's a short-term cash flow problem, or you are self-employed and there's a cash flow problem, for both this loan against mutual fund units or loan against assets work. So let's get on to the features. Number one, you can get it from a bank or an NBFC, and they will have a different sort of attributes, minor changes in attributes. For instance, the minimum loan amount for in case of banks would be much lower. So you would probably be starting at 25,000 rupees, but the maximum would probably hit not more than 20 lakhs. Whereas for NBFCs, the maximum limit can go all the way up to say 5 crores. It depends on the NBFC that you are approaching for the loan. Now remember, the loan is given against the value of your investment, mutual fund investment. It's been derived from a net asset value, NAV. Now for the amount of loan that's given for equity funds is 50%. It's typically 50% of your investment's value. So it's 10 lakhs. You only for equity fund, it's only 5 lakhs that you will get. For debt fund, it's more. It's 80%. Now remember, not all mutual fund schemes actually qualify. So there's an approved list of mutual fund schemes which will get you the loan. So these are two important riders or qualifiers that you need to keep in mind. The interest rate is pretty good and interesting. It's somewhere around 10 to 12%. You can, if you have been a long-standing customer of the bank or the financial institution, if you've got a good credit score, etc., etc., the regular stuff, you can probably negotiate and bring it down. For debt funds, if you're taking a loan against debt funds, you can probably try a little harder because the value of what you're pledging is not going to fluctuate all that much. So you're closer to, say, a loan against FD kind of a situation. So you can negotiate a little harder. There's a lien mark on these units which you're pledging, and that lien remains till you have repaid the loan. And this if because you're not getting full value of the units that you're pledging, therefore what's happening is the chances of this happening are less. Whereas if there's a fall in the value, then the units being getting sold to make up for the gap, or you bringing in some more units or making a payment. So typical loan against security kind of conditions, these are very unlikely to happen. They exist in these loans as well, but they're very unlikely to happen because there's a lot of gap between the loan amount that's given and the value of your investment. So apart from this, it's available both in overdraft form and a term loan form. So overdraft, you basically get a line of credit, and so if it's in an equity fund, you had a 10 lakh worth of investment which has been pledged, you get 5 lakhs, which is 50%. Now in the OD variant, overdraft variant, you are eligible to use this limit. Now this is very, very useful if you are not very sure exactly how much of the loan amount you're going to use. So that helps a lot, and you get charged, the interest is charged only for the amount that you use. Now remember, this loan against mutual fund units actually work very much better than personal loan, simply because personal loan are going, they will be typically going at 11 to 18%. Now this is 10 to 12%. It's much lesser, right? And of course, all the four difficulties that we mentioned, you're not having to face the difficulties that we mentioned in the introduction. So you typically need to do the usual documentation, KYC documentation. You have to give a record of your investment. This you can apply offline and you can do online. Now the digital sort of line or the digital route is to us, it appears far more convenient if you can get it done, because things will happen. You don't have to run around in this environment. So these are some of the things that you obviously will have to keep in mind when you are applying for a loan, a mutual fund loan. But again, it's important to stress that this is for a temporary, a short-term cash flow situation. You know that you have had an income disruption, maybe you're relocating somewhere, or you're between jobs, and something like a 2020 events sort of happened, and the disruption is not going to be a permanent one. That's when loan against mutual funds, they work out better than redeeming them. If it's a long-term income problem, you'll probably be in the same position, because it's as good as redeeming it, because you'll be using the mutual fund units up. So this is how you should be looking at. This is another tool that you can use in case of an income disruption, and make sure that a short-term event doesn't affect your long-term dreams, right? So we hope you found this useful. If you found this useful, hit the like button, share it with others, and subscribe to our channel. Till the next time, take very good care of yourself, and goodbye.